Howdy, folks. I got a few questions recently about, how did I know back in March that the market was, potentially going to correct? I just wanted to put out a video to show, what I was looking at back in March and the reasons why I thought the market was due to pause, and turned out, to be correct in that assumption. When it turned out that the S&P corrected about 10%, since that point in time. So this is a chart of the S&P 500 going back to 2007. And the first thing I noticed as we were going through, March of 2012 here, was that we were starting to approach levels that we had last seen in 2008. This is the peak of the market that year, which, if anybody's been paying attention to the market since that point in time, we know that 2008 was a very significant year for the market, given that we had this extremely substantial decline that year. But this year, in the first quarter of 2012, we were starting to get back to this 2008 level. And what we know as chart analysts is that when a market begins to approach, previous levels, which are regarded as resistance, as we approach them, they tend to bounce off of those levels before actually breaking through them. So without knowing anything about the fundamental picture, without knowing anything about European bond yields, what Angela Merkel was going to do about, a Greek bailout, we know that, when investors start to approach, previous levels, previous highs, that to be regarded as resistance, levels that the market will first respond to before they potentially break above. Okay, so now let's zoom into this past year. Okay, and I'll just show you, how we were able to diagnose that the market was in trouble. And let me go to this is a weekly chart of the S&P 500 of the last couple of years, but now let me go to the daily chart and let's look back over the past year. Okay, so looking back over the past 12 months or so, the market bottomed out in October of 2011 and began this really nice little uptrend here that continued through the extent of the first quarter. And just as I saw in March that the market was responding to the 2008 level here around 1420 in the S&P, it then broke this trend line. And this trend line we knew about, going back as far as, well, we were able to first project the line when the market dipped here in November of 2008, and we were able to just hold it and ride it for the next 4 or 5 months. And similar to the way that as chart analysts we know that as a market approaches previous highs, it will respond to them as resistance before breaking through them. Okay, the same, we also know that when a trend line breaks, it's a significant technical event. So you know trend lines, if they've been around for a couple of months or a couple of years, they're significant. The investors use them as points, as low points to buy against when the market takes a dip. And if you see the market taking a dip and investors do not step in to buy at the point where the market hits that trend line, then that's a significant event. It tells you that that trend line is no longer valid, that not only is that trend line no longer valid, but the market has has decided to disregard its impetus to get in and buy and continue to push the market higher. So when we look at this day here, when this trend line was violated on March 9th, 2000 or April 9th, 2012, we know now that the market is not going to trend upward in the same fashion that it had been for the previous several months. Is it going to fall significantly or not, at that point in time, we don't know. But what we do know is that the market's going to take a little breather here. And what we look for when a trend line is broken is we look for a consolidation pattern to develop. What's a consolidation pattern? A consolidation pattern is a range bound pattern of trading activity. So that is exactly what we got. Okay, so you see this trend line here, okay, broken on April 9th, 2012. And now we're looking, let me just take that line off and just show you what I mean by a range bound pattern of activity. Okay, so after that trend line is broken, we get, for the duration of April and for, the first half of May, a pattern that describes sideways motion bounded between the prices of 1420 and 1355. And I even wrote at that time, look, the line in the sand for the market is this line here. Okay, after you break an upward trend line and you get a period of consolidation, now what you're waiting to see is the market going to break back above that consolidation pattern or below it? And in this case here, on 5/8/2012, we began to test the bottom end of this range, and then finally the real final break of it was really this day here on what is that, May 14th. Okay, so really you got all the way from, going back from the first instance where the market was broken, so to speak, in on April 9th. Okay, you had all the way from April 9th to May 16th to get out, okay, to avoid the rest of this decline, which was quite a substantial and scary decline. So you could have, the first quarter of 2012, if we look back, was really a great time to make trades. After it broke out above this point here, it was a great time to make trades, to book profits, to just ride the market as far as it was going to go. And then when it broke trend, it was time to get out, to reevaluate, and to wait for the next opportunity. Okay, so that's really what I saw. Going into March, going into April, going into May, that the market had the potential to break down. And so now I'm sure everybody wants to know, okay, what are we going to do? Where's the market at right now? Okay, so I want to address that in the next video. But for those who had questions, I just wanted to put this out there to just show you how the market can be identified, it can be measured, it can be quantified. And this was just sort of the macro view. I mean, we could have really talked about very specific levels all throughout this chart. But from just a distance, we are able to ascertain whether or not the market is in a sustained uptrend, whether or not it is in sort of a rudderless, range-bound consolidation pattern, or whether it is about to establish a downtrend. And that's really what it's all about. When you're correctly identifying those moments, you are not only identifying opportunities for yourself, but you're also identifying those periods of time where you need to step back, where you need to protect yourself, where you need to reduce your exposure. And when you put that together with a solid stock specific trading strategy, that becomes the path to become successful investors in the market. So there you go, and I'll post another video soon.